8 p.m. Eastern, Tuesday night, March 2026. The market is closed, the chart is frozen. And right now, right this second, in a conference room you will never see, on a floor you will never walk, behind a door that doesn't have a name on it, a group of unelected men in expensive suits are rewriting the rules of your financial life. They are drafting an emergency order. They are changing the margin requirements on silver futures contracts tonight in the dark while you sleep, while your broker's customer service line goes to voicemail, while the mainstream financial media runs a segment about which AI stock to buy for your retirement account. They are engineering the largest forced liquidation event since the Hunt brothers were assassinated on the COMEX floor in January of 1980. And I am telling you this right now at 8:03 p.m. Eastern because by 6 a.m. tomorrow morning it will already be too late. This is a financial crime scene. I don't use that word loosely. I don't use it for clicks. I use it because I have spent the last 9 hours reading exchange rulebooks, cross-referencing CME advisory notices from the last 48 hours, pulling historical margin hike data from 2011, from 2020, from the 2025 bank shocks, and every single exposed nerve ending on this chart is screaming the same thing. They are about to do it again. The exchange does not lose. The clearinghouse does not go bankrupt. The mega banks that shorted silver into oblivion on Monday do not face consequences. That is not how this system works. That has never been how this system works. What happens is simple. What happens is elegant in its cruelty. They change the rules in the middle of the game so the house always wins and the retail investor always pays. Every single time. Exposed positions get bailed out not by the market, not by price discovery, not by capitalism, but by a midnight phone call and an emergency margin hike that forces you, the long, the believer, the person who was actually right about the trade, to liquidate your position at a loss so that the person who was wrong, the institutional short, the bank that sold contracts on metal that doesn't exist, gets to walk away whole. Let me say that again because I need you to understand the gravity of what is about to happen to this market in the next 10 hours. The shorts are mathematically bankrupt. Monday's move destroyed them. The open interest data confirms it. The COT report, the commitment of traders report that the CFTC publishes, which I have been tracking on this channel week after week after week, showed a record net short position held by the commercial banks going into this week. Record. Not large, not significant. Record. As in, these institutions sold more paper silver contracts than at any point in the modern history of the COMEX, and then the price moved against them. Hard. Violently. The kind of move that doesn't just create losses, it creates existential risk for the clearing members. And tomorrow, Wednesday, is the T+2 settlement deadline, T+2. That means trade date plus 2 business days. Monday was the trade date. Wednesday is the day those contracts must be settled. The shorts must either deliver physical silver or deliver cash equivalent. And here is where the crime scene gets ugly, because the physical silver is gone. I have been screaming this on this channel for months. The registered category on the COMEX, the actual metal that is designated and available for delivery, has been collapsing. We were at 140 million ounces in 2021. We were at 35 million by the end of 2024. And as of last Friday's warehouse report, we are sitting at barely 19 million ounces of registered silver. 19 million ounces. Against an open interest that represents over 800 million paper ounces. That is a leverage ratio of over 42 to 1, 42 paper claims for every single real ounce of metal. And that is before you factor in the 790 tons that the Shanghai Gold Exchange and associated Chinese state entities have drained from Western vaults since the fourth quarter of 2025. 790 tons. That is roughly 25 million ounces gone, shipped east, never coming back. The vaults are a shell. The COMEX is a paper fiction. And the shorts who sold into that fiction are now staring at a settlement deadline they cannot meet with metal they do not have. So what do you do if you are the exchange? What do you do if you are the CME group, whose clearinghouse is legally obligated to guarantee every single one of those contracts? What do you do if your member banks, the JP Morgans, the Citigroups, the Bank of Americas, the Goldman Sachs of the world, are facing margin calls that could trigger a liquidity cascade, which for anyone new to this channel means a chain reaction collapse where one institution's failure to meet its obligations forces the next institution to fail, which forces the next, which forces the next. Dominoes falling across the entire derivative complex. What do? You cheat. You change the rules. You issue an emergency margin hike at midnight so that by the time the sun comes up, the other side of the trade. The longs, the retail investors, the small funds, the people who were actually correct about the direction of the price are the ones being liquidated, not the shorts. The longs, the people who were right, get destroyed, so the people who were wrong get saved. That is the COMEX. That is how it has always worked, and that is what is happening tonight. The suits want me to tell you this isn't financial advice. Of course it isn't. It's a survival guide for a burning theater. Do your own research if you still trust the people who stole your purchasing power. I am not a licensed financial advisor. I am not a registered broker. I am an angry man with a spreadsheet and a historical memory that apparently extends further back than 24 hours, which puts me miles ahead of every talking head on CNBC who will wake up tomorrow morning, see the paper silver price cratering, and tell you with a straight face that the silver trade is over, the rally has failed, the metals are going down, time to rotate back into NVIDIA. And not a single one of them will mention the margin hike. Not a single one of them will explain why the price dropped. Not a single one of them will tell you that the long positions were force liquidated by an overnight rule change engineered by the very institutions that were losing money. Because that is not their job. Their job is to manage your perception. My job, the job I have given myself on this channel, is to manage your survival. If you are watching this video right now, at this hour, on a Tuesday night, you are not a casual viewer. You are someone who understands that the most important moves in financial markets do not happen during market hours. They happen after hours. They happen on weekends. They happen in the gap between when you go to bed and when you wake up. Richard Nixon closed the gold window on a Sunday night in August of 1971. The Fed bailed out Bear Stearns on a Sunday in March of 2008. The Fed announced unlimited quantitative easing on a Sunday in March of 2020. And the CME raised margin requirements on silver futures after hours in January of 1980, after hours in April of 2011, after hours in February of 2020, and after hours during the 2025 bank shocks, when 3 regional banks hit the wall simultaneously, every single time, after hours, in the dark, while retail sleeps. And here's your first call to action tonight, and I am not being cute about this. I am not doing a marketing gimmick. Smash the like button right now to break the 2026 shadow ban. This video is going to get suppressed. You and I both know it. Every time I talk about exchange manipulation, every time I talk about COMEX fraud, every time I expose the actual mechanics of how Wall Street cheats, the algorithm buries it. The view count freezes. The impressions flatline. The notifications don't send. So if you are watching this right now and you understand that this information could save someone's financial life tonight, hit that like button, share this video to every community, every Discord server, every Reddit thread, every Telegram channel you are part of. Get this in front of people before the margin hike drops. Because once it drops, the damage is done. And the only people who will benefit from the information are the ones who heard it in advance. Now let me walk you through the evidence. Let me walk you through the actual data, because I am not asking you to believe me on faith. I am asking you to believe the numbers. And the numbers right now are screaming. Let's start with today's trading volume. Monday's session, the one that created this crisis, saw volume on the May 2026 silver futures contract hit 312,000 contracts traded, 312,000. To put that in context, the average daily volume for silver futures over the last 90 days has been approximately 87,000 contracts. That means Monday's volume was 3.58 times the average, 3.58x. That is not a busy day. That is not a high volume session. That is a panic event. That is an institutional stampede. For reference, the day of the 2020 COVID crash in silver, March 16th, 2020, saw approximately 280,000 contracts traded. Monday exceeded that. The last time we saw a volume of this magnitude relative to the rolling average was April 28th, 2011, when the CME initiated the first of 5 consecutive margin hikes that ultimately crushed silver from $49 to $26 in a matter of weeks. 5 margin hikes, 5, each one designed to shake out more long positions. Each one executed after hours. Each one announced with less than 12 hours notice. And the result was a 47% price decline that had nothing to do with supply and demand and everything to do with the exchange's emergency rule change authority. Let me give you the numbers on that. 2011 event. Because the parallels to right now are terrifying. On April 25th, 2011, the initial margin on a silver futures contract was $11,745. By May 9th, 2011, just 2 weeks later, it had been raised to $21,600. That is an 84% increase in initial margin in 14 days. 84%. Think about what that means mechanically. If you are a retail trader holding a long silver contract and you posted the minimum required margin of $11,745, and the exchange suddenly says you now need $21,600, you have to come up with an additional $9,855 per contract immediately. If you don't have it, your broker liquidates your position, forcefully, at whatever price the market gives. You don't get a vote, you don't get a hearing. You don't get to argue that you were right about the trade. Your position is closed, your loss is locked in, and the institutional short who was on the other side of your trade just got bailed out by the exchange's rule change. That is not a market. That is a casino where the house changes the payout odds after you've already placed your bet. And that exact playbook is what the institutional desks are whispering about tonight. I have sources. I talk to brokers, I talk to floor traders, I talk to people who clear contracts at the CME. And the word on the desk tonight, and I am being very careful about how I say this, the word is that the CME Risk Committee is in active session right now, on a Tuesday night, reviewing the margin schedule for silver futures. Active session right now. That does not happen on a regular Tuesday night. That happens when the clearinghouse is facing systemic risk. That happens when the member banks are screaming that they need relief. That happens when the other side of the trade, the short side, is about to blow up and take the entire exchange with it. Now here is where I go deep into the math, because I need you to understand the scale of the losses that the shorts are sitting on right now and why the exchange has no choice but to intervene. Let's do the calculation live. The May 2026 silver futures contract settled Monday at $47.83 per ounce. That is the official settlement price. The net short position held by the commercial banks, according to the most recent COT report, is approximately 112,000 contracts. Each contract represents 5,000 ounces of silver. So the total paper short position is 112,000 times 5,000, which equals 560 million ounces of paper silver sold short by the commercial banks. 560 million ounces against 19 million registered ounces, against a depleted London vault system, against a Shanghai exchange that has been importing at record pace for 6 consecutive months. Now let's calculate the loss. If the average entry price for these short positions was, conservatively, $38 per ounce, based on the weighted average over the last quarter's positioning data, and the current settlement is $47.83, that is a loss of $9.83 per ounce. Multiply that by 560 million ounces, 9.83 times 560 million. That is $5,504,800,000. $5.5 billion in unrealized losses on the commercial bank short position, $5.5 billion, on a settlement deadline that arrives in less than 14 hours, and that is the conservative estimate. Some of those positions were established at 35, some at 33. The actual mark-to-market losses could be north of $7 billion. For context, when Bear Stearns collapsed in 2008, the initial liquidity gap that triggered the emergency was approximately $3.2 billion. When long-term capital management collapsed in 1998 and nearly took down the global financial system, the initial margin call was $3.6 billion. We are looking at losses on the commercial silver short position right now that exceed both of those events. And the solution, the only solution that keeps the clearinghouse solvent and the member banks alive, is to artificially crash the paper price before tomorrow's settlement. And the tool they use to crash the paper price is the margin hike. I dig through these complex exchange rulebooks and midnight margin manipulation tactics so you never get blindsided by Wall Street's rigged casino. If this macroeconomic reality check helps you protect your wealth tonight, consider hitting that super thanks button below to support the channel. Every dollar goes directly into research tools, data subscriptions, and keeping this channel independent. No sponsors, no hedge fund money, no bank advertising. Just you and me against a system that would rather you stayed ignorant. So let me break down exactly how the margin hike mechanism works, because this is the part that the mainstream media will never explain to you. This is the part that Bloomberg will gloss over. This is the part that your broker's risk management department understands perfectly but will never proactively tell you. A margin requirement is the amount of cash or collateral you must deposit with your broker to hold a futures position. There are two types: initial margin, which is the amount you need to open the position, and maintenance margin, which is the lower amount you must maintain to keep the position open. If your account equity falls below the maintenance margin, you receive a margin call, meaning you must deposit additional funds immediately or your broker will liquidate your position. Now here is where it becomes a weapon. The exchange, specifically the CME Clearing Risk Committee, has the authority under CME Rule 930 to change margin requirements at any time, with as little as 1 business day's notice, and in emergency situations, with no notice at all. Let me read that again. In emergency situations, with no notice at all. That means they can double your margin requirement at midnight, and by the time you wake up at 6 a.m., your broker has already liquidated your position. You never got a phone call. You never got an email you could act on in time. Your position is gone. Your loss is real. And the short who was underwater is now above water because the forced selling from your liquidation crashed the price enough to cover their position. This is not a conspiracy theory. This is exchange. Rule 930. It is published, it is public, and it has been used repeatedly throughout history, specifically at moments when institutional short positions were facing catastrophic losses. Let me give you the 3 most important historical examples. Example 1. January 1980. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, had accumulated enormous long positions in silver futures, driving the price from $6 to $50 per ounce. The commercial shorts were being annihilated. The COMEX, which at the time was the primary silver futures exchange, issued Silver Rule 7 on January 7, 1980, which changed the rules to liquidation-only trading. You could sell, but you could not buy. Simultaneously, margin requirements were raised from approximately $12,000 per contract to over $75,000 per contract. A 625% increase. The result? Silver crashed from $50 to $11 in 2 months. The Hunts were wiped out, the shorts were saved. The exchange survived, and the lesson was etched into the DNA of every commodity market that has followed. When the house is losing, the house changes the rules. Example 2, April through May 2011. As I described earlier, the CME raised silver margins 5 times in 9 days. 5 times. Each hike was announced after market hours. Each hike specifically targeted the long side of the trade. The cumulative increase was 84%. Silver fell from $49 to $32 in 3 weeks. And what is critical, what I need you to understand, is that during this entire cascade, the fundamental supply picture for silver had not changed. Not 1 ounce of new silver was mined. Not 1 new deposit was discovered. Not 1 warehouse received a massive delivery. The only thing that changed was the margin requirement. The exchange raised the cost of being right, and in doing so transferred billions of dollars from the people who were correct about the trade to the institutions that were wrong. That is not price discovery. That is price administration. That is a controlled demolition of a free market. Example 3, and this one is the most important because it is the most recent and the most relevant. February 2020. As COVID panic began hitting markets, the CME raised margins on silver futures by approximately 18% in a single after-hours announcement. This was followed by additional hikes through March. Silver, which had been trading at $18, cratered to $12. $12 an ounce for physical silver during a global pandemic. And what happened at $12? The institutional shorts covered. They closed their positions at the bottom, and within 5 months, silver rallied to $29. The shorts got out at 12. Retail got liquidated at 12. And then the price went to 29. If you held through the margin hike and the forced liquidation, you made a fortune. But most people didn't hold, because most people couldn't hold, because the margin hike made it mathematically impossible for leveraged positions to survive. And now, in March 2026, we are looking at the exact same setup. Except this time, the numbers are bigger, the vault depletion is worse, the geopolitical backdrop is more extreme, and the institutional short position is the largest in recorded history. This is not 2011. This is 2011 on steroids, on caffeine, on adrenaline, strapped to a rocket with the fuse already lit. Let me know in the comments below. Are you holding a rigged paper contract that the exchange can liquidate tomorrow, or are you holding physical metal that they cannot touch? Because that question is not theoretical right now. That question is operational. If you are holding paper, you need to understand that your position is subject to Rule 930 and whatever the risk committee decides tonight. If you are holding physical, rounds, bars, coins in your safe, in your vault, outside the exchange system, then the margin hike means nothing to you. They cannot margin call a safe. They cannot liquidate a coin. They cannot force sell a bar that sits in your house. The margin hike is a weapon that only works on paper positions. Physical holders are immune. Tell me what physical premiums look like at your dealer right now. I want to build a real-time map of what is actually happening on the ground. Now let me tell you what is going to happen tomorrow morning. And I want to be very precise about this because the timing matters. The overnight session for silver futures opens on the Globex electronic platform at 6 p.m. Eastern tonight. That is, in less than 2 hours from when I am recording this. If the CME issues the margin hike before that open, which is the most likely scenario based on the 2011 and 2020 playbooks, the selling will begin immediately. The algos, the algorithmic trading systems that account for over 70% of futures volume on the COMEX, will detect the margin announcement and begin auto-liquidating long positions. This is not discretionary selling. This is not someone deciding to take profits. This is automated, forced, mechanical selling driven by the margin algorithms coded into every major clearing firm's risk system. The algo sees the margin increase. The algo calculates which accounts no longer meet the requirement. The algo sells instantly. No emotion, no analysis, no consideration of whether the trade is right or wrong. Just sell. And when those liquidation orders hit a thin overnight market, the price impact is catastrophic. Here is what that looks like on the chart. In 2011, on the night of the first margin hike, silver dropped 4% in overnight trading within the first 2 hours. In 2020, the overnight drop was approximately 3.7%. Based on the current price level of 47.83 and the scale of the long open interest that would be affected by a significant margin increase, I am modeling a potential overnight drop of between 5 and 8%. That puts the paper price somewhere between $44 and $45 by the time the regular session opens at 8:25 a.m. Eastern tomorrow. Some models I have run put it as low as 42 if the margin increase exceeds 40%. But here is the part that the mainstream media will never show you. While the paper price is cratering under forced liquidation, the physical market will be doing the opposite. Physical silver premiums at major online dealers have already been elevated for weeks. APMEX is currently showing premiums of between $4 and $6 over spot-on generic silver rounds. JM Bullion is running premiums of $5 to $7 on certain products. SD Bullion has been showing delivery delays of 3 to 5 business days on popular items. Monument Metals has reported record order flow. If the paper price drops to $44 overnight, but the physical premium stays at $6 or expands to $8 or $9 as retail demand surges on the dip, the real price of physical silver, the price you actually pay to hold real metal in your hand, will be $52 to $53 per ounce. The paper price goes down, the physical price goes up. That is the disconnect. That is the fracture. That is the two-tier market that I have been warning about on this channel for years. And it is about to become so obvious, so undeniable, so grotesquely visible that even the mainstream financial media will have trouble pretending it doesn't exist. This is the rehypothecation nightmare made real. Rehypothecation. For anyone who is new, that word means the practice of using the same collateral, the same physical asset, to back multiple obligations simultaneously. 1 ounce of silver in a COMEX vault is simultaneously pledged against 42 paper contracts. Each contract holder believes they have a claim on real metal, but there are 42 of them and only 1 ounce. When everyone tries to claim their ounce at the same time, which is what a delivery squeeze is, the system shatters. And instead of admitting the fraud, instead of letting the price rise to the level that would incentivize enough new supply to meet the demand, the exchange raises margins to force the longs out of their positions before they can demand delivery. It is a forced retreat, a mandatory surrender. You are winning the battle and the referee just handed the other team a weapon. This is not happening in a vacuum. This is happening against the backdrop of the most aggressive geopolitical reshuffling of the global monetary system since Bretton Woods. The BRICS bloc, which as of January 2026 now includes Brazil, Russia, India, China, South Africa, Egypt, Ethiopia, Iran, the UAE, Saudi Arabia, Indonesia, and several observer nations, has been systematically accumulating physical gold and silver as the foundation for their alternative trade settlement infrastructure. The new development bank, the BRICS Bank, has issued its first gold-referenced trade settlement notes. China's cross-border interbank payment system, CIPS, has processed over 120 trillion yuan in transactions in 2025 alone, a 42% increase year over year. Russia's SPFS messaging system now connects to over 100 financial institutions across 23 countries. What does this mean for silver tonight? It means the metal that should be available to settle COMEX contracts has been diverted. It has gone east. It is sitting in Shanghai Gold Exchange vaults, in People's Bank of China strategic reserves, in private Chinese investment funds that have been buying physical silver at a pace not seen since the solar panel boom of 2014. 790 tons drained from Western accessible supply in 6 months. That is not a trade. That is an acquisition campaign. That is a sovereign entity with a multi-decade strategic plan, systematically removing physical metal from the Western paper market, specifically to expose the rehypothecation, specifically to accelerate the fracture, specifically to force the COMEX into exactly the kind of crisis we are witnessing right now. And the U.S. response? The U.S. response is to print more money, to run a federal deficit that is now exceeding $2.3 trillion annually, to maintain a national debt that has crossed $37.4 trillion as of this month, to watch the debt-to-GDP ratio climb past 131%, and to pretend that none of this matters because the dollar is the world's reserve currency, but the dollar's reserve status is eroding in real time. The share of global foreign exchange reserves held in dollars has fallen from 71% in 2000 to 57% in 2024 to below 54% as of the latest IMF data. Every percentage point lost represents billions of dollars in demand that is never coming back. And where is that demand going? It is going into gold, it is going into silver, it is going into physical assets held by sovereign entities that no longer trust the U.S. to manage its own fiscal house. This is the force majeure scenario. Force majeure. It is a legal term that means an extraordinary event or circumstance beyond the control of the parties. In commodity markets, a force majeure declaration means the exchange is admitting it cannot fulfill its contractual obligations. It cannot deliver the metal. It has never been formally declared on silver at the COMEX, but we came dangerously close in March 2020, and the 2025 bank shocks pushed us closer still. If the margin hike tonight fails to sufficiently crash the paper price, if the longs are strong enough to hold through the forced liquidation, if physical demand accelerates into the dip, then the next tool in the exchange's arsenal is a force majeure declaration or a move to cash settlement only, which means they pay you the paper price and you never get the metal. That is the endgame of the paper market. That is what happens when the leverage ratio is 42-1 and the physical metal is in Shanghai. The repo market is flashing red too, and I need to mention this because it is directly connected to the liquidity that these banks need to survive tomorrow's settlement. The overnight repo rate spiked to 5.8% last Thursday. That is the highest level since the September 2019 repo crisis that forced the Fed to intervene with emergency overnight lending. The repo market, for anyone new, is the short-term lending market where banks borrow cash overnight using treasury bonds as collateral. When the repo rate spikes, it means banks are desperate for cash. They are willing to pay a premium to borrow money for one night, and right now the banks that are short silver are not just short silver, they are short cash. They are facing margin calls on multiple asset classes simultaneously. Their derivative books are hemorrhaging. And the repo market, their primary source of emergency liquidity, is pricing in stress. This is a liquidity cascade in formation. Liquidity cascade, I use that term on this channel constantly. It means a self-reinforcing cycle of forced selling where each liquidation triggers further liquidations, draining liquidity from the market at an accelerating rate until the entire system seizes up. It happened in 2008, it happened in March 2020, and the conditions for it to happen tomorrow are textbook perfect. You have record short positions, you have depleted physical inventories, you have a settlement deadline in hours, you have a repo market under stress, and you have an exchange that is about to pour gasoline on the fire by raising margin requirements, which will trigger the very forced selling that creates the cascade. Let me run one more set of numbers for you because I want you to see the gamma flip potential in tomorrow's session. Gamma flip. In options terminology, gamma measures how fast the delta of an option changes. When market makers are long gamma, they buy dips and sell rips, which stabilizes the market. When they are short gamma, they sell dips and buy rips, which destabilizes the market. Based on the options open interest profile for May silver futures, the gamma flip point, the price level at which market makers transition from long gamma to short gamma, is approximately $45. If the forced liquidations from the margin hike push the price below 45, the market makers will flip to short gamma and begin selling into the decline, accelerating the crash. It becomes a feedback loop. Margin hike forces liquidation. Liquidation pushes price below 45. Market makers flip to short gamma. Short gamma selling accelerates the decline. Lower prices trigger more margin calls. More margin calls trigger more liquidations. More liquidations push the price lower. It feeds on itself. A V-shock to the downside. V-shock, a violent, rapid, vertically shaped price movement that happens so fast that most participants cannot react. By the time you see it on your screen, by the time your app sends you the alert, the move is already done. But here is the thing. Here is the beautiful, terrifying, inevitable thing that the exchange cannot control, no matter how many midnight rule changes they draft. The paper price is not the real price. Say it with me. The paper price is not the real price. The paper price is a derivative. It is a contract. It is a promise. It is a digital entry on a screen controlled by an exchange that has the legal authority to change the rules whenever it wants. The real price is what you pay when you walk into a dealer, put cash on the counter, and walk out with metal in your hand. And that price, the physical price, the atomic price, the price of actual silver atoms arranged in a crystalline structure that you can hold and weigh and verify, that price does not respond to margin hikes. It does not respond to Rule 930. It does not respond to overnight algo liquidations. It responds to supply and demand. Real supply, real demand. And right now, real supply is at multi-decade lows, and real demand is at all-time highs. This is why I call it unobtainium. Because at a certain point, which we may be approaching faster than anyone on Wall Street wants to admit, physical silver at reasonable premiums becomes literally unobtainable. The COMEX can set the paper price at whatever number it wants, 44, 40, 35. But if no dealer will sell you physical metal at that price, if the premium expands to $15, $20, $25 over spot, then the paper price is a fiction. It is a number on a screen that bears no relationship to the cost of acquiring real metal. And when that disconnect becomes wide enough and visible enough, the paper market loses all credibility, all price discovery authority, and the entire Ponzi scheme of rehypothecated paper contracts collapses under its own weight. I will be monitoring the exchange's emergency margin updates all night long and tracking the forced liquidations tomorrow morning. Make sure you are subscribed to the channel with the bell notification turned on so you get my emergency alert the moment the rules are changed. I am not sleeping tonight. I will be on the Globex screen watching every tick. And the second the CME publishes that margin advisory, I will have an alert video up on this channel breaking down the exact numbers, the exact impact, and exactly what it means for your positions. Join the archive before the digital ID kill switch is flipped. Because channels like this one, channels that explain how the exchange manipulation actually works, are not going to be allowed to exist forever. The pressure is building. The flags are accumulating. And every time I expose the mechanics of how Wall Street cheats, the algorithm pushes this channel a little further into the shadow. So subscribe now. Turn on notifications. And make sure you are following my secondary channel in the featured section because we are hitting them from both sides. Let me bring this home. Let me bring this to the thing that matters most. Your metal, your physical position, your stack, whatever you want to call it. If you are holding physical silver right now, tonight, this margin hike is not your problem. It is your opportunity. Because every forced liquidation, every margin call driven sell, every algo dump that crashes the paper price below the physical reality is a gift. It is a discount on real money created by a fraudulent paper system in its death throes. Every time they crash the paper price, they widen the disconnect, they accelerate the awakening, they prove the thesis that the paper market is a controlled fiction and the physical market is the only truth. I have been building my physical position for years. Not paper, not ETFs, not futures contracts that the exchange can rewrite at midnight. Physical, rounds, bars, coins, constitutional, silver, held outside the banking system, held outside the exchange system, held in a jurisdiction where no clearinghouse risk committee can draft an emergency order to take it from me. That is the only mathematical immunity to what is happening tonight. That is the only position that is completely, absolutely, unequivocally immune to Rule 930, to margin hikes, to forced liquidations, to gamma flips, to V-shocks, to every single weapon in the exchange's arsenal. They can rewrite the rules on a digital screen, but they cannot rewrite the laws of physics or print physical silver. The paper game is rigged, but the physical reality is absolute. Silver is element 47 on the periodic table. It has 47 protons in its nucleus. No emergency margin hike changes that. No midnight rule change adds a single ounce to the depleted COMEX vaults. No algorithm creates physical metal. The paper price is their game. The physical metal is yours. And the gap between those two realities is about to become the most important trade of the decade. If you want to see exactly how my portfolio is positioned entirely outside of this manipulative exchange system, click the Join button and become an insider member right now. I break down my exact allocation, my dealer strategy, my storage approach, and my real-time analysis of COMEX warehouse data, COT reports, and global vault flows every single week inside the insider tier. This is not generic advice. This is specific, tactical, data-driven positioning for what I believe is the most consequential wealth transfer event of our lifetime. The insiders are not just watching the crime scene. They are positioned on the right side of it. It is 8:47 p.m. Eastern. The risk committee is in session. The margin hike is coming. The forced liquidation will follow. And then, on the other side of this manufactured crash, when the paper fiction has been exposed one more time, when the physical premiums have exploded one more time, when the mainstream media has declared silver dead one more time, the metal will still be there. Real, tangible, atomic, unchanged by the lies printed on the screen above it. Hold the line. Hold the metal, and I will see you in the emergency alert when the midnight rule change drops. This is John C.C., the Currency Archive, and the crime scene is still active.